The central bank in the U.S. Said it's ready to consider cutting rates as inflation drops closer to its target range. The Fed held off raising the rates today. But keep in mind, they've dramatically forced prices down. The new data suggests that projections on damaging the economy through those aggressive rises have, for the most part, not happened. Owen Fairclough explains.
Has the U.S. central bank, the Federal Reserve, finally won the inflation battle? It hasn't raised its benchmark interest rate since last July, after ramping it up to drive down prices that spiraled out of control in 2022. And now that inflation has been largely tamed, Fed Chair Jerome Powell is under pressure to cut that rate. The question is when.
We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
And how this post-pandemic inflation crisis has been solved is a puzzle.
And it's one that even some experts are struggling to explain. Jerome Powell warned that that series of interest rate hikes designed to bring down inflation would be painful for businesses and consumers and might even trigger a recession. Instead, the opposite has happened. The US economy is outperforming every other advanced economy, wages are rising, and employers continue to expand their businesses by hiring more staff, even when the costs of doing so were elevated by those interest rate hikes. And it doesn't stop there. The projection for 2024 is also pretty good for the US.
Even so, with that benchmark rate at around 5.5%, it's driven up the average 30-year mortgage so much, many prospective buyers have been priced out of the market. One argument for cutting rates.
What we're trying to do is identify a place where we're really confident about inflation getting back to 2% so that we can then begin the process of dialing back the restrictive level.
And yet, with the economy defying expectations, some economists think the Fed needs to consider the lag between hiking interest rates and their impact on the economy before taking action. Owen Fairclough, CGTN, Washington.
For more on this big decision or no decision, we're joined by Preston Caldwell, Chief U.S. Economist at Morningstar Research. I read some of your stuff, love it. And, you know, one of the things about this particular meeting today was the expectations going into it. And of course, I saw the headlines afterwards, and I'm guessing you're not surprised by the reaction.
Yeah, the reaction makes sense. So, you know, a couple of weeks ago, the markets were baking in, let's say, a 50% probability of a rate cut in March. That's drifted down a bit, and then by this afternoon, we've gotten down to about a 1/3 probability of a rate cut in March. So that makes sense, just given what Powell said. You know, it took him a while, but it was puzzling. It took about 40 minutes into the press conference, but eventually he said pretty clearly that a March rate cut isn't their base case.
I mean, it's almost comical, right? Because he comes out and says almost the same thing he says last time, which is we're going to look at the data, we're going to see how things go, yada, yada. And then you have this big press conference, which everybody tries to get him to say something different, and they ask the same question in about 14 different ways. He probably got fed up by the end and says, look, we're not planning on cutting. No one has said they're cutting. You guys are the ones that want us to cut. We've never said anything about it. Like, he could not be more clear that the cutting is not on the table. And then you're telling me there's still a 1/3 chance, apparently, that he cuts in March. And then we can talk about what the summer might look like. But does that change your perspective on what summer might look like in terms of rates?
Yeah, it's funny. He kind of cracked under interrogation at the end, I guess. But I wouldn't say that it's not on the table. I mean, you know, they're definitely stepping in the direction of rate cuts. If you look in the statement, the language changed from focusing on the conditions for further tightening to now talking about a symmetric adjustment in the federal funds rate. So cuts are now entering into the conversation. But yeah, I mean, I would say it's not the base case, but we're going to get a lot more data before March. So it certainly shouldn't be ruled out. Inflation has surprised on the downside relative to the Fed's expectations. And so if that continues, it's not impossible we'll see rate cuts in March.
Here's my question, and I've asked this to friends in the business, friends in your business, and just general people who follow the market stuff, right? In the history of the Federal Reserve, whenever they were to actually cut rates by more than a few, times, there was always a somewhat crisis that was perceived, which is why they would cut, basically step on the gas or save the economy, prevent whatever disaster is out there. Why would the Fed at all at this point need to cut, whether it's March, May, June, whatever the month might be? What would instigate the Fed to cut? Why is it in their interest to do so, and why should they?
So, according to their assessment and that of most economists, rates are at restrictive levels. So that means levels that are designed to depress or cool off the economy in order to bring inflation down. Now, admittedly, we haven't seen that so far. I mean, GDP was up 3.1% year over year in the fourth quarter. But, we have no idea whether the effects of rate hikes have fully played out in terms of economic activity. I think that they haven't. I think there's still a great deal of effects that are in the pipeline if rates remain high, because borrowing costs will continue to rise and a lot of debt still has to be rolled over to high rates. So the question is, do you want to bear that risk if it's needless? So if inflation returns to target, why would you keep rates at restrictive levels? Because there's no further benefit to keeping rates high at that point, and there's only downside risk.
And if they were to cut, whether again in March or summer, I believe the last thing I saw was that people were expecting 5 or say 6 rate cuts, which is like, what, 125 or 150 basis points. I'm going to ask you, do you think that is overly optimistic? And if it is, what should the expectation be?
Yeah, I mean, I think the market's got it right now, and I've thought for several months now, at least, that there will be 6 rate cuts in 2024. So yeah, I think starting with May, they will cut every meeting, and that will only take the federal funds rate to 3.75% by the end of this year, 3.75 to 4% target range at year end 2024, which is, still at slightly restrictive levels. So that's hardly, the kind of response that we might expect to occur if a recession, say, occurred. So I think that's just moving back to normal.
Now, in fairness, you mentioned the word restrictive, so I'll go down this rabbit hole. He did not emphasize restrictive. In fact, I think some of it was even kind of lightened up in terms of being the restrictive. So I'm wondering, if you are right and they do cut rates 5 or 6 times, what impact would it likely have on the economy?
I think it's more about averting a potential downturn in the economy. When we look at the vulnerabilities that are out there in commercial real estate, I think the vulnerabilities that are in housing, if rates don't ultimately come down, because I think many home buyers right now are buying on the hope that they can refinance at lower rates down the line. So if that hope disintegrates, then I do think the housing market will take another leg down. So there's a lot of vulnerabilities if rates remain high, and I think it's just about averting that downturn that could materialize.